Yeah, let's talk about the broader market, bring in Gregory Branch as well for that. I mean, we spent a lot of time today talking about these meme stocks, given that move in AMC. But, you know, Gregory, particularly as we are now only a month away from the start of the second half of the year, where are we in your opinion, and what's coming when that second half begins?
Right. So I look across the sectors and I still see consensus light of what the true earnings power probably is. When you look at a lot of these sectors, consensus is reflecting 60, 70% of what pre-pandemic earnings power represented. Now, between here and there, we will have to deal with, the market will have to digest inflation, what it's going to be and what the impact on the market is. And so at the top of the show, you talked about the sectors that have outperformed, and that's largely the inflation trade. When you talk about financials showing strength, that's on the back of an improving net interest margin environment. When you talk about energy, that typically has performed in inflationary environments. And I think that that's right. But at the same time, I think the Fed will have to move off of its posture that long-term inflation has a 2.5% outlook. The monthly sequential data is not supporting that. Both CPE and CPI came in well ahead of consensus on a month-over-month basis. And so I think that the market is struggling with how to deal with that right now.
It feels like, though, the market is kind of still in the Fed's camp, Greg, that it's going to be transitory. We don't have any proof yet that this is going to be anything beyond just the great reopening, the surge in demand, and coming off of the base effects last year, which were very depressed.
Right. And you're right. We don't have any proof yet, but we certainly have some signs. And so with regard to the base effect, yes, it contributes to a large year-over-year number, but we can eliminate the base effect when we look at the month-over-month numbers. And when you talk about what's transitory and what might be a little more lasting, I look at certain commodities. Lumber's up over 120%. Copper's up over 40%. And so I'm not sure that that's transitory, like when we're dealing with inflation from depleted retail stock, like inflation that we're dealing with from broken down supply chains that haven't sufficiently repaired yet. So that's actually the work, is figure out what of this is transitory and what of this we haven't even experienced the full effect of yet, like the homing effect. So home prices, when we talk about rents, typically trail increases in home prices by about 15 to 18 months. So we haven't even seen the full burden of that yet in the inflation numbers.
All right, I want to get to Josh Lipton now. We've got HPE earnings coming out. Josh, take it away.
HPE reporting Q2 results here, 46 cents. That's versus expectations. 46 cents. That's versus expectations of 42 cents. So a beat on the bottom line there. Revenue up 11% to 6.7 billion versus expectations of 6.6 billion. Q3, they're looking for between 38 and 44 cents. That's a bit conservative at the midpoint relative to expectations of 43 cents. They are, though, raising their guidance for the year. They're now looking for between $1.82 and $1.94. The street was at $1.80. I did have the chance to speak to HPE CEO Antonio Neri. I asked him about that ramp up in enterprise spending that clearly a lot of companies have been flagging here. He said, we are seeing strong demand in connectivity, compute and storage, and data analytics. So across the portfolio, he said they're very confident in back half demand given the momentum they're seeing in orders. Bottom line, he said customers need more IT right now, not less. On that ongoing chip shortage, he said we have taken actions in preparation for a tightening of supply. HPE, he said, has factored that short-term challenge into guidance, and it is well-positioned, he said, with its inventory and the type of solutions offered. Remember, this stock was up about 35% year-to-date heading into this print. Conference calls at 5 p.m. Eastern. Back to you all.
Yeah, interesting comments on the chip shortage, how they take that into account. We'll be watching that closely later as well. Josh, thank you. Josh Lipton on HPE. You can see the stock looking down just a bit. Let's get a check on shares of AMC, of course, after really a wild day for that stock. It surged over 20%. Let me just check where the close was, actually. 22.6%. Of course, this after the theater chain disclosed that it sold more than 8 million shares to investment firm Mudrick Capital, which then sold them as well during the course of the day for a profit. It's the latest in what are a series of capital raises that the company's done since its stock first began this surge amidst, of course, Reddit-fueled retail investor mania. Began earlier this year. AMC, by the way, is up 1,400% just since the beginning of the year. CEO Adam Aron also took to Twitter to defend the decision, saying AMC will use the extra cash to pick up important theaters from other faltering chains. But I'll tell you, Sarah, the more I learn, the more questions I have. Mudrick did not return my calls this morning. They were involved in a junk convert for the company, and I just feel as though we're going to learn even more here about exactly what occurred. As unusual
you mean
as it is,
they provided debt financing during the depths of the crisis?
I'm wondering right, exactly, and I'm wondering whether there was perhaps moved through the strike and beyond, and they converted the debt, which resulted obviously in a decrease in the amount of indebtedness, which you could argue is an increase in equity. I guess simply to say, I'd still like to do more reporting here on exactly what went on, but it's extraordinary enough, just the move today, the ability of the company to raise capital, and of course, what was essentially a day trade that ended up probably being worth as much as $30 million in profits to this firm. Well done.
It's an unbelievable deal. Flip up 23%. Is there anyone who's on the other side of this trade? Is this still a short squeeze?
I don't think so. I think many investors are afraid to short it and have been for quite some time, and simply are standing back while they watch this, which is yet another reason why. Well, we'll see. Perhaps what is in store for AMC, but it is $13+ billion market value, far, far beyond anything it had prior to the pandemic, and of course, its large shareholders have all sold out.
Well, the box office is coming back. You can say that. We've got Zoom video results just out. Let's hit them with Deirdre Bosa. Deirdre.
Sarah, once again, Zoom handily beating expectations, but shares are falling in the after hours as the street has come to expect big earnings beats, and perhaps this wasn't as huge as what they've become used to. Still strong numbers, though. Earnings per share coming in at $1.32. The estimate was for 99 cents. Revenue was $956 million. That's up 191%, so not that 200% number that investors have become accustomed to. The estimate was just $906 million. There were some expectations that perhaps it could hit $1 billion in revenue this quarter. Did not do that. Q2 outlook was strong, expecting 114 to 115. That's versus 94 cents for earnings per share. Revenue between 985 to 990 million. That's better than the street expected. They were looking for $932 million. Strong full year EPS and revenue guidance as well. Shares are down about 3.25%, guys. They're making up some ground because these were still strong results, though. As we spoke about, this stock has doubled over the last year. Back to you.
Deirdre, thank you. And don't miss the Zoom CFO on Squawk Box tomorrow morning, 8:20 a.m. Eastern Time. She will be there. Greg, just wanted to get your quick take. One other number that stood out to me in this Zoom release, just about 2,000 customers contributing more than $100,000 in trailing 12 months revenue. That's up 160% from the same quarter the last year. That's one of the keys that analysts were looking forward to in this report to show the sustainability of what's happening with Zoom, the higher paying, bigger enterprise customers. What do you do with a stock like this?
Right, you're exactly right. One of the fears on this name is that all of the gains that they had in COVID, how much of that is sticky? How much of that is sustainable? And when we get numbers like that on the higher end in terms of the revenue, that gives us something of an answer. Those are not transitory revenues. And so Zoom has several legs that I think are underappreciated by the market. Not only in terms of the growth of its video business, but its phone business is growing at triple digits. And so what I expect is that they will have to significantly raise their full year guidance. Where it's sitting at right now seems overly conservative in that they'd have to add about half of the incremental revenue in each quarter that they added in the fourth quarter in order to just beat their current top line estimate for the year. So we'll see some upward revision there. We'll see, I think, more stickiness in terms of their customers than the street was expecting over the next quarter or two. But I'll admit, we're going into a few tough compares in terms of their quarters. And so I think the market will take a bit of a wait and see approach as we go through those toughest quarters, this and the next. But on the other side of that, I think that the market will have to account for all the growth drivers here that I don't think are priced in at this level.
All right. Yeah, full fiscal year 22, total revenue expected to be $3.975 billion. Greg, thank you. Peter, thanks to you as well. Appreciate both of you joining us.